In the summer of 2024, the United States government spent more on interest payments than on national defense for the first time in the nation's history. Servicing the federal debt consumed roughly $870 billion that year, a figure that eclipsed the entire Pentagon budget. And yet, on January 21, 2025, standing in the White House, beside President Donald Trump, three of the world's most powerful tech executives announced they were prepared to spend $500 billion on artificial intelligence infrastructure. SoftBank's Masayoshi Son, OpenAI's Sam Altman, and Oracle's Larry Ellison unveiled Stargate, a joint venture promising up to $500 billion in AI data centers over 4 years, beginning with $100 billion in 20 planned facilities, each spanning 500,000 square feet. Ellison revealed that 10 data centers were already under construction in Texas. Son called it the beginning of a golden age. The president called it a resounding declaration of confidence in America. Nobody in that room mentioned that the country was already running a fiscal deficit expected to exceed 6% of GDP, or that the project's own financing was, at that exact moment, still largely theoretical. To understand how America arrived at this paradox, you have to rewind to the summer of 2022, when Congress passed the CHIPS and Science Act appropriating $52.7 billion to reshore advanced semiconductor manufacturing. The logic was straightforward and urgent. Taiwan produces over 90% of the world's most advanced chips, and a single earthquake, blockade, or conflict could paralyze everything from smartphones to missile systems. The Commerce Department eventually awarded Intel $7.865 billion, Taiwan's TSMC $6.565 billion, and Samsung $4.7 billion to build cutting-edge fabrication plants on American soil. TSMC committed to a $65 billion investment across 3 facilities in Arizona, starting with a 4-nanometer fab scheduled for commercial production in mid-2025. But there was a catch. Building a semiconductor factory in the United States costs an estimated 40 to 100% more than building the same facility in Taiwan and takes roughly twice as long. TSMC's Arizona project, announced in May 2020, required 4 years just to reach production. By the time it came online, the company was already mass-producing more advanced 3-nanometer chips in Taiwan at volumes 5 times larger. The reshoring effort was real, but it was also expensive, slow, and strategically incomplete. Stargate represented something different. Unlike the CHIPS Act, which used taxpayer money to subsidize manufacturing, this was supposed to be private capital, answering a national call. The initial structure gave OpenAI and SoftBank 40% ownership each, with Oracle and the UAE's MGX holding 10% apiece. SoftBank and OpenAI were each expected to contribute $19 billion in initial capital, with the remainder raised from limited partners and debt markets. The project promised over 100,000 jobs and a network of facilities generating more than a gigawatt of computing power, enough to rival the output of a nuclear power plant. Ellison spoke of personalized cancer vaccines. Altman spoke of ensuring American dominance over China. Son, who had previously committed $50 billion to U.S. investments during Trump's first term, only to see a significant portion swallowed by the WeWork catastrophe, now pledged to go 10 times further. The symbolism was impossible to miss. This was the Manhattan Project for the algorithmic age, funded not by the Treasury, but by the optimism of billionaires. Except Manhattan projects require actual money, and from the beginning, observers questioned whether Stargate had it. On January 22, 2025, Elon Musk publicly cast on whether the venture could meet its promised investment levels, noting that SoftBank simply did not have the capital on hand. He was not wrong. By April 2025, SoftBank was scrambling for financing, arranging $10 billion in bridge loans from Japanese banks, including Mizuho. In May, J.P. Morgan Chase agreed to lend $2.3 billion for the flagship Abilene, Texas campus. But debt is not equity, and bridge loans are not foundations. By August 2025, Bloomberg reported that the project had not formally started and had raised none of the initial $500 billion budget, stymied by market uncertainty, American trade policy, and the simple reality that AI hardware valuations had begun to wobble. The joint venture, despite its White House rollout, had reportedly not hired a single employee as a unified entity. The fractures ran deeper than cash flow. According to reports from The Information, OpenAI initially wanted to own the data centers outright, a move that would reduce its dependence on Microsoft and other cloud providers, but would require capital it did not have. Investors balked, forcing Altman back to the negotiating table. Oracle secured the first major deal, promising 2 million chips of compute capacity, but the three-way partnership devolved into a tug-of-war over site ownership, system control, and trademark rights. A marathon session at SoftBank's Tokyo headquarters was required just to settle the Texas arrangement, with SoftBank winning ownership of the land while OpenAI retained design control and a long-term lease. By early 2026, Oracle's debt had ballooned to $105 billion. Bondholders were filing lawsuits over misleading statements, and the planned expansion at Abilene had been abandoned after negotiations between Oracle and OpenAI collapsed entirely. The UK arm of Stargate, announced with fanfare in September 2025, was paused within months due to power costs and regulatory hurdles. The financial architecture of the broader AI boom reveals why Stargate struggled to find solid ground. In 2025, the 5 largest technology hyperscalers were on track to spend over $1 trillion on AI-related capital expenditure across just 2 years, commitments that outpaced their own earnings and free cash flow. To fund this, many were issuing debt. Morgan Stanley estimated that debt used to finance data centers could exceed $1 trillion by 2028, with many of these bonds carrying BBB or junk ratings. JP Morgan's analysts calculated that the projected $5 trillion global investment in AI infrastructure would require generating $650 billion in annual revenue indefinitely simply to deliver a 10% return. That revenue does not currently exist. What exists instead is a pattern of circular investment, NVIDIA pouring $100 billion into OpenAI, which then uses that money to buy NVIDIA chips, OpenAI buying billions in AMD hardware, making it one of AMD's largest shareholders, Oracle, signing $300 billion in cloud deals. The Bank of England has warned that these valuations could collapse if infrastructure costs prove too high, and the International Monetary Fund has drawn explicit comparisons to the dot-com bubble of 2001. History offers sobering parallels. The Bank for International Settlements, the central bank for the world's central banks, published an analysis in 2025 comparing the current AI investment boom to the canal mania of the 1830s, the British railway mania of the 1840s, the electrification exuberance of the late 1920s, and the telecom crash of the early 2000s. Each episode began with a genuine technological breakthrough. Each attracted capital in excess of what commercial returns could ultimately justify. Each ended with an investment bust that dragged the broader economy into recession. The BIS noted that when competitive pressure drives capital expenditure higher, the net economic surplus for the sector as a whole declines and can turn negative in adverse scenarios. A sudden pullback in financing could transform the current capex boom into a protracted bust, with knock-on effects across financial markets. The physical constraints may arrive before the financial ones. In 2024, American data centers consumed an estimated 183 terawatt-hours of electricity, roughly 4% of the nation's total. By 2030, the International Energy Agency projects that figure will more than double to 426 terawatt-hours, with some forecasts suggesting U.S. data centers could consume between 8 and 12% of national electricity. A single next-generation AI campus can require 1 gigawatt of power, equivalent to a small city. In Northern Virginia, data centers already consumed 26% of the region's electricity supply by 2023. In July 2024, a voltage fluctuation triggered the simultaneous disconnection of 60 data centers, creating a 1,500 megawatt power surplus that forced emergency grid adjustments to prevent cascading blackouts. Goldman Sachs research estimates that $720 billion in grid spending may be needed through 2030 just to support data center growth. The question is not merely whether the tech companies can afford to build, but whether the American power grid can afford to keep the lights on. And if the demand never materializes, the costs will not simply vanish. Utilities across the country are already making expensive upgrades to transmission lines and generation capacity to serve projected data center loads. In the PJM electricity market stretching from Illinois to North Carolina, data centers drove an estimated $9.3 billion price increase in the 2025 to 26 capacity market, raising average residential bills by $16 to $18 per month in some states. Carnegie Mellon University estimates that data centers and cryptocurrency mining could lead to an 8% increase in the average U.S. electricity bill by 2030, exceeding 25% in high-demand markets like Central and Northern Virginia. If the AI boom falters, those infrastructure investments become stranded assets, and the ratepayers left holding the bill will not be tech billionaires. They will be homeowners in Ohio and Maryland who were never asked whether they wanted to subsidize the infrastructure for a chatbot. This is the core of the gamble. The United States is attempting to simultaneously reshore semiconductor manufacturing, build the largest AI infrastructure project in human history, and maintain global technological leadership against a Chinese competitor that spent roughly $280 billion on its own domestic chip industry between 2014 and 2024. It is doing this while carrying a national debt of over $35 trillion, running annual deficits north of $1.5 trillion, and paying nearly $900 billion a year just in interest. The CHIPS Act has already catalyzed an estimated $158 billion in real investment. But much of that money is flowing into factories that produce chips at higher cost and lower scale than their Asian counterparts. Stargate promised to layer another $500 billion bet on top of that foundation, but 15 months after its announcement, the joint venture remains fractured, its financing dependent on bridge loans and bond offerings, its expansion plans scaled back, its flagship project competing with Microsoft for the same Texas real estate. The deeper risk is not that AI fails to transform the economy, the technology is real, and the productivity gains are measurable in pockets. The risk is that America has confused technological destiny with investment destiny, assuming that because artificial intelligence will matter, every dollar spent on its infrastructure today is a dollar well spent. History has never worked that way. The dot-com era gave us Amazon and Google, but it also vaporized trillions in market value and destroyed companies that built fiber optic networks for traffic that would not arrive for a decade. The railway manias connected continents, but they also bankrupted investors and required government bailouts. A technology can succeed while the capital deployed to build it fails spectacularly. In Abilene, Texas, construction crews still work daily on the first Stargate data centers, 8,000 workers moving across 1,100 acres. The steel is real. The concrete is real. The debt, too, is real, but the revenue to justify it remains a forecast. A projection, a belief that somewhere in the training runs and inference queries of the next decade, there waits a product valuable enough to pay for the power plants, the transmission lines, the chips, and the $500 billion dream. The United States has made its wager. It has bet that it can outbuild, outspend, and outlast every competitor in a race where the finish line keeps moving. Whether that wager secures the future or simply adds another chapter to the long history of American booms that built too much too fast, for returns that never came, is a question the country will not be able to answer until the bills arrive, and by then the debt will already be owed.